Welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmgren, and with me is my colleague, Niklas Sävås. How has the summer been for you, Niklas?
It was a great summer. I actually had some time to relax and spend a lot of time with my daughter, and I had some time in Greece, in Crete, which was very good. But the weather was a bit too good. It was too hot.
Yeah, it's been a warm summer. I stayed in Sweden this year, actually. I usually travel, but it's been nice. I've been reading a lot, and we've been launching the podcast, which has been really fun. But it's also good to be back in the studio and now record some new episodes here for the fall. Today, we are delighted to have two guests from Diamond Hill Capital Management, an Ohio-based investment firm with about $30 billion of assets under management. And we are fortunate to be joined by both Heather Brilliant, she's the CEO and president of the company, and also Krishna Mohanraj, and he's the portfolio manager of the International Equity Fund. And the starting point of our conversation today is the book Why Moats Matter that Heather Brilliant co-authored in 2014 when she was the CEO of Morningstar Australasia. And to us and many investors, this is a classic, but for those who don't know, what is this book about, Niklas?
So the first part of the book is about Morningstar's framework for investing, while the second is how they apply the framework to different industries. And I would say the book basically answers two key questions. One, how can we identify a great business? And two, when should we buy that business to maximize our return? And as the title suggests, the book is about moats, also referred to as barriers to entry. And the term moat was popularized by Warren Buffett and is a core principle of Morningstar's equity research process. But Eddie, what is a moat?
Yeah, for people not familiar with the concept of moats in this business context and who might be thinking of the water-filled trenches that are protecting medieval castles from invaders. Well, in this case, you can easily replace the castle by a company and the potential invaders by competitors. But the question is which kind of economic moats a company can have to protect themselves. And in the book Morningstar, they list 5 sources of different moats. It's cost advantages, it's intangible assets, it's switching costs, efficient scale, and network effects. And Morningstar also rate companies depending on the kind of moats that they judge they have. They have 3 different ones, and one is companies that have no moat, no durable competitive advantage, and no long-term staying power. The second one is companies that they think have a narrow moat, and that is companies that have a competitive advantage and are likely to provide excess returns for investors for the next 10 years. And then they also have a third one, wide moats, which is companies that they believe can provide excess returns for 20 years, but that is very rare. So the book also has one chapter about the trends, how these competitive advantages are increased or decrease. It's also covering stewardship, like capital allocation, and the managers, who are they and how are they treating the company, and also about valuation and portfolio strategy and so on. So, but from the framework of Redeye quality rating, what will today's episode focus on?
We will discuss both how a moat can show up in the numbers, but as well from studying the characteristics of the business and the industry. So it's important to look at both parts, as an emerging moat can be shown in the qualitative side, but not yet show up in the numbers. And I mean, on the business side, as you know, the Redeye rating is based on business, financial, and people. And on business, we have questions regarding moats, which is how competitive the industry is, threats of substitutes, identifiable moat, and if the market share is growing. On the financial side, we focus on the return on capital over the cost of capital, as well as if the business have high and stable margins.
All right. And the last part in our rating is the people. Is there something there?
Yeah, so people itself doesn't constitute as a moat in terms of how Morningstar sees it. But I mean, by allocating capital in a good way, you can widen the moat and vice versa. So I mean, depending on the actions of management, they can either strengthen the moat or weaken it.
Perfect. And we'll talk more about moats in this episode, where we discuss it with Heather Brilliant and Krishna Mohanraj. Heather and Krishna, welcome to Investing by the Books podcast.
Thanks for having us.
Thank you, guys.
Yeah, so just to start off, Heather, you've been more than 10 years at Morningstar. You worked at First State Investments, and now you are CEO of Diamond Hill Capital Management.
That's
so what
right.
what has this like transition meant for you, both personally and professionally? And how do you feel about everything right now?
Well, from a transition standpoint, this is definitely the most challenging, rewarding, and exciting opportunity I've ever had. My prior roles, I was really heading up a division or an area of a larger company, and this is my first role being the ultimate CEO and having kind of ultimate accountability. It's a lot of pressure, but it's a lot of autonomy too. And I love it. I think Diamond Hill is just a really unique company in our industry. And I'm sure we'll talk a little bit more about that, but it's been a really, really amazing opportunity.
Yeah, and Krishna, what is your background and current role at Diamond Hill?
Yes, I co-manage the international strategy at Diamond Hill. We are coming up on the 5th anniversary of the strategy, so super excited about what we're building here. I remember I joined Diamond Hill almost 10 years ago now, which was when the firm just started investing in their international capability, and I had moved back from London to take up this job. You asked about my background. It's been I would say kind of a circuitous path for me to get to investing. I have a very quantitative background. I was trained as a engineer in operations research, so which basically means using optimization algorithms in supply chain and logistics. So very different background from fundamental investing. Somewhere along the line, I got my CFA. Given the math background, I worked for a while as a quant, but never really enjoyed it. I think I'd overdosed on quant, and of course, like many other people, came across Buffett letters and started reading. I don't know exactly when, but it kind of turned into an obsession, fundamental investing, and it felt to me like there's a lot of subtlety to fundamental investing that as a quant, at least, I didn't perceive it. As a quant, it felt like you're building weapons to go to fight every day, like in a sort of zero sum game. But value investing and this mindset of fundamental long term investing seemed more like a slow sort of a learning journey, rather than a competition on a daily basis, right? So completely different mindset. And I have to say, thinking long term is a lot less stressful, and it's way more productive. So that's, I think, kind of when I decided this is the only thing I wanted to do. So here I am.
So it seems like your investing style is really fundamentally driven. How would you describe your style?
I would say, I mean, it's changed. It's changed over time. I think when I started, I remember I was in London Business School. I, um, I had this course called Value Investing, which was taught by Eddie Ramsden, who was a professor who used to teach in Columbia's Value Investing school. He had just moved to the UK, his native UK, and he started the course there. So I got lucky. I did that class, and that class was very much based on the Greenblatt style of investing. Like finding um, overlooked situations, spin-offs, stuff that's maybe not on the front page of the journal, but like in the 10th page, hidden somewhere, right? So initially, at least, I had a sense of finding opportunities, capitalizing on them, and I thought that was the idea of a good stock pick. But I think over time, I've become more interested in where do I place my money and my clients' money for the long term, rather than just finding ideas. There's a little bit of both, so it's not one or the other. But I think that's just the mindset of, I would call it kind of more like a collector's mindset. Uh, See, I want to collect and sort of curate a portfolio of businesses that I think I would want to place my money in for the very, very long term. So that's maybe a subtle shift in how my thinking has changed over the years.
Yeah, I think I've done more or less the same journey myself. So it's interesting to hear. But I mean, the thing that is really hard with investing is all these biases. And I mean, how do you deal with biases, and which biases are most maybe prominent in your investing life?
Uh, I feel like, sometimes I feel like I have every bias in the book. Like, you go through that list. I'm like, oh yeah, I've done that. I've done that. And I think in our context, I guess in the investing context, most of the biases have to do with how you process information, right? And the issue is there's just so much information, um, and I'm saying quote unquote information. Uh, so if I had to pick a few, I would say nearness bias is big. There's a tendency to just overweight what I just heard, and I'm aware of it, but it still makes a difference. Availability bias, of course, which is the more something is available, I tend to emphasize it. So aware of that. Confirmation bias is big. I think a lot of people, and I find this, like, I get a thought in my head, and then somehow I seem to have a penchant for finding really nice articles that align with that new thought in my head, right? So all of that happen all the time. It's
I actually think confirmation bias is the most dangerous bias in investing because you have to be able to look for disconfirming evidence and to be able to incorporate it in a way that can, help you still understand what your thesis is or how the world can fit together with this new information. But if you purposely fit the information to the story that you're telling yourself, as Krishna was describing, then I think that's just the biggest trap in sticking to a loser or riding a position for longer than you should and things like that.
Yeah, is that something you work with actively at Diamond Hill? Like how to deal with the biases?
you mean from as a group, right?
Yeah, like in a group, and if you discuss it among the different fund managers, or if that's something that you work with, Heather, to group together
So
people.
we have, within our team, so in international, we are a team of five and we work very closely together. So pretty much every idea, every thought is discussed either over email or at least once a week. So we try to play devil's advocate. And the other thing I think we do very well is when one analyst has an idea, it's more than likely that all information that seems interesting, pro and con, when somebody else finds it, they will send it across. And there is no, I would say, um, I've been in other places where if an analyst has a positive view and you're a peer, or it doesn't feel comfortable sending a negative view across to the whole group. But in our team, I think we've set it up in such a way that nobody feels it as an attack on your idea. Like, it's just an incremental addition, and I think it also goes back to the framework of, it's not an idea. It's not that you want to get into an idea, make money, and get out. Right? It's more like, how long do we want to own this position, and up to what valuations we are willing to hold this position, and if everything goes well, we want to hold it for a very long time. And if you want to hold something for a very long time, you have to keep checking if your original thesis is right. Are things changing? Is it sustainable to maintain that position in the portfolio? I think that mindset um, helps you kind of at least be open to the anti view, if you will, right? But I
I would
think,
say across our investment team too, I have been really impressed with people's willingness to acknowledge, disconfirming data, and I do think it's something that we try to reinforce with our culture. So one of the key tenets of our culture is curiosity, and I think if you are constantly curious about how new information fits in and try to stay open minded instead of just trying to fit it to a story, that kind of learning mentality can really be a great counter to a confirmation bias risk.
yeah, that's right. Chuck Bath, our most senior portfolio manager, if you hear him talk, he he's always bringing in the contra view, right? He's always, I mean, he might have be holding the position, he might be adding to the position, but he's like, this is what I'm worried about, and this could go against it, and blah blah blah. It's never hey, this is my idea and it's going to work, because he's just seen the cycles of ideas and how they work. So, um, but I think one thing Heather mentioned in terms of seeking contrary input, I feel like it's become super important to filter what you consume, right? Just like what you consume as uh, what you consume as food, it's almost in a similar way. What you consume as information is extremely important to your health. Whether it's in just in the investing context or even broadly in life context, it's become the number one thing. And so that's something we always keep thinking about. I'm always changing the kind of sell side research I view. Um, we don't read as much sell side research, but sometimes it just pops in your inbox and you have a tendency to look, and each one of those looks takes up your attention. And there is a, I forget what I think Cal Newport in his book, he had a good point there, that each 10-second change in attention can actually cost you way more than that 10 seconds. So very very be very mindful of how you spend your time. um, the other things I think is I find that having an intrinsic value based investing approach is really good, because you might be getting a lot of new short term information, but ultimately we're tied to that intrinsic value estimate, and that estimate doesn't change that much, right? So um, if the headline today says that the beer market or the hard seltzer market is down XYZ% last week, it's a negative to a beer thesis. But it doesn't really move the intrinsic value estimate much. So in that extent, the behavior of the team is somewhat smoother than the information that comes in. That's one thing. And the second thing, and I think it's sort of a personal philosophy, and I think it's a team philosophy too, and international and maybe across the board, is gradualism in most of what we do. So the decision making is not abrupt. Um, I'll give an example. Let's say you have earnings come out for a company this morning, and for whatever reason the stock is down 10%. More likely than not, we wouldn't be adding to the position this morning, right? Um, yeah, it's more likely that we would want to listen to everything the company's put out. We would want to listen to everything the peer or the competition is putting out this earnings season. We would want to wait a week before we have a full understanding of what the reaction was, why there was a reaction, how does our long-term estimate and intrinsic value changes. Then we might add or we might not add, but it's just that in the emotion of the moment, we're not making a big decision. That I think that gradualism helps too when it comes to biases. At least it gives us the time to be aware of what bias we might be having.
Right, and we'll get back to the investing philosophy at Diamond Hill a bit later. But this is Investing by the Books podcast. We usually have one book as a starting point, and the one for this week is the book you co-authored, Heather, Why Moats Matter, and came out 2014 when you worked for Morningstar. And we were a bit curious why did Morningstar decide to put their methodology into a book, and what was your role in this project?
Sure. Actually, Morningstar has put its equity research methodology into a book multiple times. And Why Moats Matter is the most recent publication that kind of outlines the philosophy. But the philosophy was first outlined in a couple of books a decade or more ago. And this is the first time that I was involved in working on this project. And it was really a wonderful opportunity, because at the time that we wrote the book, I was leading Morningstar's equity research team. And I wanted the book to be the opportunity for the team to share their insights, which are clearly much deeper when it gets down to specific industries and sectors and companies on which they have insights around economic moats. But clearly, we needed to reevaluate and re-articulate the framework in order to kind of bring everything together. So I wrote the first chapter of the book and was kind of leading the effort to coordinate multiple contributors across the team. And every other piece of the book was really written by someone from the team. The second chapter was written by Elizabeth, who at the time was the head of the US research team. So I was the global head of the team, and she was heading the US. I think she's still with Morningstar, actually, but she's moved on to a different role at this point. So
interesting. And I mean, part one of the book covers the framework of Morningstar's philosophy centered on economic moats. And while you, as you said, you cover moats in different industries and sectors in the second part, can you just, for our listeners, I mean, how do you define a moat, and can you elaborate on the major sources that you outlined in the book?
Sure. So first of all, a moat really at its essence is a company's ability to earn returns on capital in excess of the cost of capital for long periods of time into the future. Some people equivalate moat to a sustainable competitive advantage. And so that's kind of, I think, the easiest way to think about it and the most direct. But one thing that Morningstar always focused on in thinking about companies with moats that I think has been just a very foundational part of how I think about analyzing companies and competitive advantage is that a moat must be a structural element of the business. So you can have positive contributions to a company's competitive advantage from things like culture or management, but fundamentally there has to be a structural element to a competitive advantage. And so at Morningstar, we kind of articulated that into 5 particular categories under which a company could earn a competitive advantage. There's a cost advantage, which is pretty straightforward. That's, can you produce a good or service at a lower cost than your competitors? Intangible assets, which are usually things like brands, patents, or a regulatory regime that protects your ability for some period of time to earn excess returns. Switching costs, and switching costs really used to apply very heavily to kind of old school technology companies like Oracle or SAP, and now I would say there's kind of a merging between switching costs and network effect. Network effect is the fourth moat source, and network effect is really about the value of a business becoming greater as there are more users on both sides. And that is where I think there has been the biggest change in terms of competitive advantage analysis and the markets and what's going on, but we can talk more about that. The final moat source is what we call efficient scale. And this is a moat source. This book is the only book where Morningstar talks about efficient scale, because as we were writing the book and really thinking about our methodology, we really felt like there was a category of competitive advantage that wasn't well captured in the other sources that we had articulated. And so it was very challenging to come up with what to call it, because when people hear efficient scale, they think scale. But actually, the scale of a business generally leads to a cost advantage. So that really goes into the first source. Efficient scale really refers to this concept that there are some markets that are really not large enough to support the addition of another competitor. And so when you have that circumstance, that's when we call it efficient scale. So it could be like a pipeline, where adding another pipeline would make both completely uneconomical. Pipelines have other sources of advantage too, regulatory approvals, et cetera. But importantly, I think that they own a market that really is not profitable for another entrant to come into.
Yeah, it's a niche that they dominate.
Exactly.
And has your view on moats changed after you wrote the book?
I mean, I'd say the biggest change, as I kind of alluded to, is that network effect used to be the most rare source of competitive advantage. And we had done, over the decade or so that I was working with the research team at Morningstar, we had done some studies on the frequency or prevalence of different moat sources. And network effect was consistently the hardest to find source, but also the one that led to the greatest outsized future returns when you found it. Well, I think everyone's figured that out now. And and we see the market dominated by these businesses that benefit from network effect. Also, for as long as I have been thinking about competitive advantage, technology in its various forms has always had the ability to really completely upend the way competitive advantage works in a particular industry. And I think what you've really seen over the last, 5+ years is the network effect advantage upending the technology industry itself. And that's partially driven by, everything moving to the cloud and software as a service, but it's also really driven by this new level of connection that happens online. And I think, when we all think back to our childhoods where, there was barely even email and there was certainly no ability to Google the answer to everything you want to know, that it's hard to really imagine when you take a step back how much has changed, both in terms of the overall economy as well as in terms of the sources of companies' competitive advantage. One other thing I'd say that I would say my thinking has evolved on, and this is a little bit funny given my current role, but I do think that I have increasingly placed more emphasis in my own mind on the importance of management in terms of making great capital allocation decisions and influencing the culture of the organization, and really identifying talent and hiring the right people. I think those are the contributions that management can make to enhancing a moat. I still think there needs to be a structural component, but now as management, I would like to say that I would have some ability to influence our future competitive advantage.
But I know that other people think that corporate culture is actually a moat. So it's a bit. Some investors think that.
I mean, Buffett thinks that. Buffett has made comments to that effect, and that was one area where we always consciously differed from kind of Buffett's moat methodology. And I think it's partially because it's very hard to identify or explain a culture related advantage in any structural way. And also it can be very fleeting. Culture can really depend on a few key individuals. And so if your moat can walk out the door, then Morningstar doesn't consider it a moat.
Yeah, that's something we read about in Jim Collins' great book, where he talks about these time tellers and clock builders, which is really interesting, with the time tellers being like Kodak or those kind of companies where the CEO is really knows the future, and that's one person who knows the future, but they don't build it structurally like a clock, so it doesn't last for long.
Yeah, and I think that's a great way to think about it or put a framework around it.
Yeah, definitely. So how do you use moats at Diamond Hill? Is that something you have brought with you?
Well, I would say it's something that was well established before I got here. And it's funny, in preparing for this podcast, since this book is, 7 years old at this point, I was rereading the first chapter and thinking about how much alignment there is between, the way Morningstar has articulated its investment philosophy in this book and the way we think about investing at Diamond Hill. And I'd say probably Diamond Hill would put the intrinsic value estimate or the valuation maybe above the competitive advantage analysis in terms of maybe even the order of operations. But ultimately, I think that there's a fundamental agreement that the best investment opportunities are comprised of companies with sustainable competitive advantages trading at a discount to their intrinsic value. And so fundamentally, I think we really are very aligned. I don't know, Krishna, if you want to add to anything about the Diamond Hill philosophy in comparison.
Yeah, sure. Before that, I just want to comment on the management moat question, because I thought it was very interesting. Heather, you brought it up. I know Buffett has, there's this Buffett quote: when a bad business meets a good manager, it's the reputation of the business that survives. I guess he's making the point that the business is more important than management. But I disagree. Just using Buffett's example, right? He meets Berkshire Hathaway, which is a terrible textile business, and look what he's done with it in this time. It's just, you cannot simply say that moat is the only thing that matters and management doesn't. If you have exceptional management, it makes a huge difference. I think even in our portfolio companies, we worry a lot about management change, because a lot of the investment case sometimes is based on the history of management. One recent example is HDFC Bank in India, which we've owned for a while. The CEO is I think you guys mentioned the term intelligent fanatic. He probably would fall in that category. He founded the bank, I think in 1994, if I'm getting it right. So it's almost close to 30 years of history of building a bank in India from scratch to be the best run bank in the country. and I would say one of the best run banks you'll ever come across. You just have to look at the numbers over the 30-year period in terms of loan growth, underwriting across that time. It's so hard to create a culture that is both risk averse and entrepreneurial, right? Because when you're building a financials business, if you incentivize selling too much, it comes back to bite you every time the cycle turns. It's just every bank, the history of every banking cycle. You'll know who's been too exuberant in lending, right? So they've been able to build it, and he retired, I think, 19 in 20. So that CEO transition was something that naturally I was concerned about, but the new guy comes in, and one of the first things he did was he talked about changing the entire tech stack, almost creating a separate tech stack for HDFC Bank from scratch, parallel to what was going on. So he was trying to reinvent and break the technology of the bank, knowing fully well that's the biggest threat for the bank is tech, right? That mindset of investing for the future, investing a 10-year, 20-year horizon seems to be sort of embedded in the banking culture across the management team. So you could say it's management or culture, but I mean, I guess it's semantic whether it's part of the mode or not, but it's important. And I guess that's the big point. And then I guess in terms of how we use moats and Diamond Hill, yeah, to Heather's point, yeah, it's pretty much looking for sustainable competitive advantage, but at the same time worrying about what we pay for it. Um, I would say this. I think over the years I've realized the concept of moats can be a little can be subtle. It's really not the well-known moats that are going to make you money. It's really understanding the subtlety of where exactly the moat is coming from and how it's rather where is the limit of that moat, right? That you don't understand easily, and you cannot just get it from a sell side report or it just takes a while to be able to put your finger on where the limit of the moat is. And I think as an investor, you're more worried about making sure you truly understand. So I can classify a moat as one or typically two or three categories the moat might fall in, but does it stop at the border of the market they're operating in? Can they extend that moat to a new market? Those kind of questions are harder to answer, and sometimes you need to drill deeper and maybe just stay with the company for a while before you can understand it. I'll give you an example from the portfolio. We own a company called Howden Joinery in the UK. Um, it's they provide trade kitchens, which means they sell kitchen remodel products to tradespeople. So if you wanted to get your kitchen remodel and you went to them, they won't sell it to you as an end customer. They'll ask you to go and find a contractor, or they'll suggest a tradesperson who can then go to them on your behalf. So that's the business model. Um, um, it's pretty easy to see that they have a moat. Okay, so all you have to see is you can see the high gross margins, you can see high returns on invested capital, you can see stable to increasing market shares over long periods of time. So they must be doing something right, and they have some competitive advantage. But what exactly is the competitive advantage, right? And we've been in the name, I think, for more than 5 years now, and it's taken us a while as a team to really kind of get a good sense of what that moat is. It is a cost advantage. It's an intangible asset. All of that is true, but I mean, if I have to explain it, the tradesperson want to pick them because they have a vertically integrated supply chain. So that means they're better at stocking. So as a tradesperson, I'm worried less about the cost, more about if something goes wrong, can I go to Howden and get it fixed versus going to a Home Depot equivalent or a retailer equivalent who might or might not have the part and wouldn't really care about the success of the entire project, right? So there is very few alternatives who do the same thing well. So that's part of the moat. Um, it's but it doesn't end there. It's actually there's a lot more to it. Um, and how we found that out was we started seeing that they were trying to expand in France. Okay, so it's been a few years now. They branched out into France, but somehow they were not able to have the same level of success in France. Uh, so initially, you thought it's the French customer, maybe they're different, but that wasn't the case. The real answer to the puzzle was depot managers. How they manage the depots is extremely different from the competition. So they incentivize their depot managers to be owners. So as a depot manager, you get a profit share, and you make decisions on investing in your depot, which takes away from your profit share this year, but could potentially increase revenues and profit share in the future, right? So it's a different mindset from a paid employee with a bonus. It's almost an owner operator mindset in a decentralized fashion. So if you have that structure, and that's a big part of why you're successful, they're finding that they're not able to build those kind of or find those depot managers in France. Okay, and they've tried for a while, and the people that have trained under them in the UK, they don't want to move to France to do the same thing, or at least, and even if they did with the language, they're not as successful in hiring and managing people. And I mentioned this because it's kind of in the back of my mind and in the team's mind recently, is because they're expanding into Ireland, and they're making the case that, hey, we have a lot of Irish people in our payrolls now who are trained and experienced. We think they can go in and get this, the snowball rolling in Ireland. So we'll see. But it's just fascinating because I can classify the mode quite well, but can I give them the growth rates in France or Italy, that knowing the UK market is saturated, or are they done, right? So it's an interesting puzzle. So I feel like the bottom line is moats are super important. And as an investor, the edge comes from trying to understand the boundary of the moat as much as just the moat itself, right?
I think that's a really great example of how we have so much more flexibility as as a buy side firm, as Diamond Hill, to interpret and deepen our understanding of competitive advantage. Morningstar is publishing Moat ratings, and so they need a framework that can kind of be applied in a more general way. Their business need to analyze moats is very different from ours. And I think that does give us a tremendous amount of flexibility. So, like the framework in the book is a very helpful starting place, but it's definitely not the ending place if you're really making investment decisions on a daily basis.
Yeah, maybe this will be a bit off topic, but I was thinking about it when you mentioned this. When you move something that works in one region to another region, we have this. Yeah, you're familiar with the Swedish company IKEA, and there's a story where they tried to implement the beds that they had in Europe into the US, and it failed because your beds are much bigger than than here in Europe. You wanted king size, and it failed. So it's I was thinking also about the valuation side, because everything is baked into a valuation in the end. But in fact, I mean, I think Morningstar has different scenarios based on future events that they foresee, and I think they have three values, like a bear case, a base case, and a bull case, or something similar. That's the model we have at Redeye, so it's a bit similar. And do you use such a model at Diamond Hill, or how do you work with the scenarios there, and how do you consider the concept of black swans?
So I would say, first of all, that we have, as I was kind of mentioning philosophically, we have a much greater degree of flexibility at the analyst level than, a firm like Morningstar can possibly provide its analyst team. And what that allows for us is that we can create scenarios, and the number of scenarios can differ depending on the circumstance. So we don't have a framework where we require a bull case and a bear case, for example. But what we do is we really think about what are the possible outcomes for this business, and how do we factor that into an intrinsic value that we can communicate effectively to multiple portfolio managers. In Krishna's case on the international team, it is a very tight-knit team, but on our domestic equity team, we have about 20 analysts communicating with about 10 portfolio managers. And so that means that there's constantly, different portfolio managers with incrementally different perspectives on businesses and industries and things like that. And so making sure that we kind of have the right framework depending on the industry and the company gives us greater flexibility. I will say, though, I definitely distinguish, and I think you would as well, between scenario analysis and sensitivity analysis. And so we do have kind of a built-in sensitivity analysis where we're looking at, what does a different discount rate or what does a different exit multiple mean for our valuation for this business? And that we do very consistently because it just gives more comparability on something that, none of us ever really will know the answer to. So, but scenarios, I would say we have a very flexible approach.
So, also, Heather, you have several funds, and you mentioned that the analysts have a lot of flexibility. But do you have like an overall strategy on how to beat the market in Diamond Hill?
Yes, our overall philosophical approach to investing is exactly what Krishna has been describing. So we believe in taking a long-term perspective, understanding the fundamentals of the business. We want to be long-term holders of the businesses that we own. And so we're always looking for businesses that may have a competitive advantage that are trading at a discount to intrinsic value, or where we can buy them with a margin of safety relative to what we think they're worth. So that is a consistent theme that runs across all of our equity portfolios. And then even on the fixed income side, where intrinsic value is not exactly applicable, we still take a long-term perspective. We hold a lot of the underlying bonds that we hold to maturity, and we take into consideration the what we believe to be the valuation or reasonable valuation for the bond, even though intrinsic value is not exactly applicable.
Yeah, I can maybe, add to that both the philosophy question and tie it into valuation as well. I think the first question, or I think the place to start would be to ask the question: do I want to own a piece of this business for a very, very long time, right? Do I want to place some of my client business in this money run by this management team? And do I feel comfortable leaving it in there for a long time? So that's the starting point, because that question will eliminate a lot of quote unquote opportunities that pop up, like the latest hot IPO or the newest minted crypto coin or whatever it is, right? All of those. The minute you realize you're not in there for the short term, you're not in there because you think the stock price is moving up, that eliminates a lot of the stuff, and it simplifies your thinking. If my money can stay in there for a long time, then I don't even have to consider it. Like, problem solved, right? So you get through that hurdle before then you get to curating what is the best of the best investments that I can invest in.
It also depends which investors you have and that they have like the staying power and don't withdraw funds at the worst time.
Very lucky over the years. During different crises, I remember 2008, I was told this, that a lot of the clients stuck with us even when there was a 30-40% drawdown in the markets. And again, during COVID, we saw net inflows. So it's I think we're grateful for the clients that we've been able to build together. And I think it's been a sort of a concerted effort from the management team to focus on the right kind of clients as well.
So that's certainly been true in recent years. I mean, I've only been with Diamond Hill for 2 years, so that's all I can really speak to. But it has been a very purposeful effort to cultivate long-term relationships with our clients and to make sure that when someone invests with us, that we're philosophically aligned about having a really long-term perspective, and that means that we will perform differently than the market. And that means sometimes we'll perform worse than the market over shorter periods of time. And we really try to partner with clients who can take a full market cycle perspective. Now, we all know a full market cycle has been a hard thing to find in the last 10 to 15 years. So that is, that has presented its own challenges. But But overall, that the partnership with kind of people who also have a long-term perspective when they're making their investment decisions has been a critical component of how we've built our business.
Yeah, I guess it comes down to trust at the end. And for an investment manager, it's always the challenge of career risk and how much are you able to deviate from index. But it seems like you have a good approach and a lot of flexibility there.
Absolutely. I would say we do not want any of our investors thinking about an index when they're making the decisions that they are making about what to invest in, or all of our portfolios are very highly concentrated compared to competitor portfolios, compared to things that are indexes that we might be compared to by ourselves or our clients for benchmarking purposes and things like that. And that's very intentional. So.
Yeah. So here at Redeye, we are a Nordic and a Swedish based, but a Nordic focused when we look at different companies. And we have about 150 companies under coverage. They're mostly the tech and life science business. But we saw that your fund, Krishna, you have one Nordic company, Assa Abloy, which is represented 2% of the fund, at least at the end of June. So we are a bit curious what your view is about on the Nordic sector.
Yeah, it is. It's such a coincidence because exactly when we started this recording, Assa Abloy has a call because they announced an acquisition in the US. We'll talk about that too. That's what I have to work on when I finish this podcast. But
it's all about priorities.
Yeah, you know the company well. It's definitely not a thesis on the Nordics. It's a global company. In fact, we haven't really done much work in the Nordics recently. Probably worth dusting up our old notes. I used to follow the insurance sector there and keep looking for cheap stocks. I remember Sampo, the insurance company, was one of the most. I remember Bjorn Walrus. He was the CEO in 10, 11, 12, that time frame. He's one of the most interesting speakers I've met. I think I've heard him speak many times. It's a great insurance market. The problem is you rarely find stocks cheap there, but yeah, always worth looking. Going back to Assa Abloy, you have the global moat that comes from scale, right? They can invest more in R&D, in M&A, have a bigger sales force. They offer a comprehensive solution for both, retail and commercial. In fact, just today they announced that they're buying their second largest competitor in the US on the retail side, which the market apparently really likes. Those are big advantages that the largest player in a still highly fragmented market enjoys, right? So they can compound that advantage over long periods of time. I think over the last 5 years, they've spent 3 times as much on R&D as the number 2 player, Dormakaba. These are all a collection of little things that kind of indicate to you the power that you have over time. And the market is still so fragmented that they're so far away from being considered a monopoly or anything like that. So that's the global case, right? But there's also another part to it. It's the local scale. I think close to 2/3 of their revenues come from the aftermarket, and aftermarket is typically a local scale game. So you need to have you need to build scale market by market. So there is a global scale to it, but there is a local angle to it, and you see that in a lot of other businesses too. Unilever is a portfolio holding. They have a large stable of billion-dollar brands. Everybody's heard the brands, Unilever brands. But you go to Indonesia or India, people think of these as local brands. Hindustan Unilever is an Indian company, and that's how those brands are perceived. And you might think of Dove as a global brand, but Lifebuoy is an Indian brand. So that advantage is actually extremely hard to build. And so when you have that, I think the trick is to value it appropriately. And that's really the case for Assa Abloy.
I also wanted to ask you about the piece you wrote on meme stocks back in July, where you described that you bought BlackBerry in December 2020, and then in a way won the lottery when it became part of the meme stock hype. I'm curious to know how you took advantage of the situation, and more in general, how you minimize the risk of thinking there may be something I'm missing when a stock price goes that quickly.
Yeah, I think the short answer is it's all about intrinsic value estimates, right? And to some extent, also having a sense of to your earlier question on scenarios and the sensitivity, having an intrinsic value estimate and having a clear sense of the upper ranges of what something could be worth. And once you know that clearly in your head, it's a lot easier to manage. I'm not saying it's easy to manage, but it's a lot easier to manage, because if you didn't have that, if you didn't know the value of something and something is going up 30%, 40% every day, it is just extremely hard to react. I think the whole BlackBerry situation for us is very interesting, and it's a learning experience for us. And so there's probably more lessons than just in staying disciplined to intrinsic value estimate. And we're still processing it. It became a meme stock, as you noted, but it used to be a deep value stock for a very long time. In fact, you would call it a value trap, right? And we knew of this stock secondhand because we are invested and we have been invested in a Canadian insurance company called Fairfax, which is run by Prem Vatsa. It's again a lot of value people know the thesis and the stock, and they had bought BlackBerry or got majority ownership in BlackBerry as early as 2012 or 13, when pretty much with iOS and Android, BlackBerry was an also ran, right? Like, it was really not in contention. So they got BlackBerry for very, very cheap for a long time. They It's been a 8-year turnaround in kind of trying to extract the IP out of BlackBerry and sort of turning it into a software company from a handset hardware company, right? So it's been a long, long journey, and we know of it simply because Prem Vatsa's quarterly calls and the annual reports. He always has a paragraph on it. He already talks about it. So when one of our analysts, he started working on it, Chris Peel as the analyst, it was a well-known idea to us, and I was able to contribute to it. The rest of the team was able to contribute to it, and the timing was just fortuitous. But we kind of know what the valuation is. We kind of know what the upper limit on the valuation is. So when the stock went 10%, 20% over that, it was kind of easy to exit. Overall, it's an amazing experience to go through for the team because, well, conceptually, we all are in agreement with what we do, and we've been able to do that well in normal times, right, over extended periods. It's still good to know that we can do it when things are crazy on like on an hourly basis, right? And as you mentioned, there's always this fear of missing out or not knowing what we could be missing, because when things are going well, you kind of think that. And I think it's also a lesson on Mr. Market and the moods of the market, how that could change. Something could be dead in the water for 8 years and then suddenly like rise up. It happens. So there's probably more lessons there. I still haven't processed it enough.
Just to follow up on that, did you sell the full position or did you keep part of the position?
So what we did was we had a sizable position going in, and we trimmed it down to a bare minimum when it went above our estimates. And that's something that we've been playing around with as a team as well. All the analysts contribute and have a say in what they think. And sometimes with some of these names, when there's too much volatility, it just psychologically it's easier for us to have a little bit of a position in there because we know we want to build a big position, and our mindset is over a long period of time, BlackBerry is an interesting stock. It's just that at these prices it is not, right? So I don't know if it numerically makes any difference having 50 basis points in there, but it just psychologically it helps us gives us continuity with the position. No scientific reason for doing it.
Yeah, this is something we discuss a lot here, like when to sell and should you trim or should you just sit through and let the stock run and trust the management that they will do good things, and it comes back to capital allocation, I guess.
Yeah, and I think when the moves are really that crazy. We don't. I mean, if it's a high quality compounder kind of stock and it's a little overvalued, that's a different decision. But if it's clear that there is froth and hype around it, then over 10% over our estimates, our upper end estimates, I think the discipline should be to exit, for us at least.
Yeah, definitely. So when we come back to the moats, and one part is also the trends, how the moat is increasing or decreasing, and how that process works. Something that I have been feeling more and more is that like innovation and digitalization is really like increasing the substitutes for different products. It's harder to keep the moat. And what's your thoughts about that? And how do you really like track the competitive landscape? We talked a little bit about it.
Yeah, I think it's. I mean, I guess to some extent, I would say it is. It relates to your capital allocation slash management question, like, because moats are moats are not final, right? Moats are evolving. There are limits to the moat, and as you say, the landscape is always changing, and it seems like the landscape is changing faster over more recently with technology, right? So a lot of the traditional quote unquote old school businesses. I would say a couple of things there. The first thing is, and I think this is a Bezos quote as well, is that you can ask about what is changing a lot, but the more interesting question is what is staying constant, right? So if you can find businesses where you think things are on balance more likely to stay constant rather than change, that has additional value in the portfolio, right? So that's one lens of thinking about this, because it's not always easy to predict change. I mean, it is hard to predict change. Um, so the bigger question to ask is, A, what is staying constant that I can hang my hat on? And B, what is management doing about change, right? So it is, and you go to the second question, it's extremely hard, I think, from the outside to judge what management is doing. It's very easy to get carried away one way or the other. Um, and a lot of times I think Diageo probably is my favorite example, because Diageo is a quintessentially British company, right? You think Diageo, you think they own the largest collection of Scotch whiskey brands. You think Diageo, you think Scotch. The history is also fascinating, right? It shows how much, similar to kind of Berkshire Hathaway, how much wealth can be created over long periods of time when a management invests appropriately, right? And this is like multiple centuries of doing it. You can trace the company's origins all the way back to 1749, right, to the J&B blend. The J&B brand, it's a blended Scotch whiskey brand. And then, of course, Johnny Walker comes in 1819, and that itself is more than 200 years ago now. So very, very long time ago, very local British firm. But look at the firm today, right? Only 6% of revenues come from their home market. So it's as much, it's a global brand. It's a spirits powerhouse. All of that's been created over this time, and you can't argue things haven't changed over that time. And there's been like two world wars and how many other events. What has sustained that brand, right? Then you look at it today and say, hey, even 2 years ago, Diageo paid, I think, $1 billion, an insane amount of money to buy Casamigos, which is George Clooney's tequila brand, and everybody was super negative on it. And I was like, that seems like super expensive for a nascent tequila brand. But 2 years hence, I think there was like 85% growth in Casamigos last year and something like 125% growth this year. They've, from nowhere in tequila, they've managed to establish a position in the US tequila market, and it's about 8% of their revenues now. So from the outside, you can look at these decisions and say, hey, it seems expensive, but over time you have to kind of give management the benefit of the doubt, especially when they come from a culture like that of real long-term history. of investing appropriately. And I think that's maybe a learning over time, is that give management a longer leash, especially. Uh, I guess I'll put it this way: first, make a call, really understand management and their history, and once you made the call, give them a little more leash on what they're doing. So it doesn't directly. It's not easy, so it doesn't answer your question directly, but it's more subtle. I feel like of how you worry about more trends and worry about what management is thinking. And
Yeah. And this is still your biggest position in the fund, right?
yeah, as of the last disclosed.
Yeah. And but you said like you can pay a high valuation. What would that be? Like, how is it trading currently, approximately?
I think from a valuation perspective, it is not cheap, but it is. It's. I mean, personally, I don't think it's super expensive either. Given the quality of the firm, and to your point, if you value sustainability, if you value, I mean, what am I more likely to predict? Um, Revenues for Diageo? Am I more likely to be right in predicting revenues for Diageo, or maybe some other company in my portfolio? I'd say Diageo is probably one of the is up in the list.
Conviction, I hear. Yeah.
Actually, I mean, just from having studied this in the past, there's a huge correlation between an analyst's ability to predict a intrinsic value successfully and a company having a wide moat. The wider the moat, the more clear the competitive advantage, the easier it is to predict what the future cash flows will look like. And I think that's all very intuitive, but Morningstar has done some studies around that too, so they can prove it as being true as well.
Right. And related to that, I was a bit curious on pricing power, because that's also an important element. How much do you think about that when you invest?
Yeah, see, pricing power is everything, right? It's in fact, I'll flip it around. I've learned to appreciate places where the company is not exercising pricing power, but it has it. I think the big example is TSMC. Uh, TSMC is the global foundry leader, and um, a caveat to that is recently they announced price increases, so I'll leave that out of the picture. But they're essentially a monopoly in the space, and the biggest advantage for them is they have been extremely diligent about not passing on too much of their cost increases to clients. In fact, making the client experience better every day, sort of the Amazon model, right? Um, Faster, cheaper, wider selection, that kind of mindset. When you have those kind of shared economies and your intrinsic cost structure is falling over time, right? You have even more of a more you create even more of a moat by pricing lower, right? It doesn't. You're already making significantly high gross margins. Why, why not use the opportunity to enhance your moat? Those kind of situations are rare. Costco is a big example of that. But
I
when
think
you,
that's a great example too of just having a different time horizon. And, similar to the way we think about investing with a different time horizon, I think as when you can find management teams that have a truly long time horizon in the way they run their business and that they're incentivized to have a longer perspective, I think that leads to better decision making on things like when to hold back on the pricing power you have. And I think pricing power too is kind of an example or an outcome of a source of competitive advantage, right? Like it's pricing power in and of itself can't explain, but it can be a piece of evidence that leads you to dig deeper to say, well, what is it about this company's business that gives it pricing power?
Yeah. And another way to look at it is to look at the companies that have no pricing power and then see, okay, who are they in touch with? Those companies definitely have pricing power.
Yes, absolutely.
I was also thinking, Krishna, you mentioned Fairfax, and I think they are an example of. I mean, when you discuss the role of capital allocators, you typically speak about businesses that I mean are similar to Fairfax, where they have many different companies in the group, and the ones that are earning money sends the excess profits to the headquarters for them to allocate it to new interesting opportunities.
Yeah.
And I was thinking, how do you assess a good capital allocator?
Yeah, like I said, going back to the Diageo example. It is extremely hard to do looking ahead, and I think the history is very, very important. And you mentioned Fairfax, so I'll use that. I'll use their history, right? I think since 2008, uh, Prem has been wrong on a lot of his investing bets. He's been famously predicting the market crash and buying all these deflation puts, and that's cost shareholders a lot. So that's kind of the time frame we decided to get into the stock, because it is clear that he's taken too many macro bets. So his strength has been building an insurance business. His strength has been investing in businesses, but not taking macro bets. So you could ask a legitimate question: that is his capital allocation skills? Is he playing in a has he deviated, right? Is there style drift? But despite that, right, you look at the long arc and say, hey, I will give him some leash, because he's the kind of person who corrects, right? He makes a mistake and he corrects over time. And of course, valuations provided a lot of support, because at the same time that the investing side was struggling because of his mishaps, he had done such a good job on the insurance side by hiring the right people. He'd realized the mistake that he had made maybe in the late 90s, when he was buying really bad insurance businesses and trying to turn them around. He'd figured out that doesn't work. When in insurance, and you want to buy good insurance businesses, because insurance is a lot about culture and people. Uh, it's extremely hard to turn around a bad insurance book, especially if it's a long duration book. So he had figured it out, and then he'd started buying better insurance companies, and the underwriting track record in by the time we got to 2010 had turned to really, really good, like consistent, positive, profitable underwriting, low combined ratios, that sort of thing. So you're saying, okay, it's a mixed bag, but let's look at the history of value creation here, and look at what you're getting, what you're getting for nothing more than paying book value, right? So I think it's always a mix of questions. I can't just stand up here and say, hey, he's the ultimate capital allocator. He's not. He's made mistakes on both sides, but he's a learning machine, and he's created this team that is extremely I guess what the word is, extremely value minded. So I've been to their offices in Toronto, and it is not what you would expect. It's like these plastic tables, with the old school phones, and they are super kind and nice, and they offer you water, and the water is not bottled water or Perrier. It's like water that comes from they just go and fill water in a cup for you. Like that mindset, it's still there, and they're like, they're worth billions. So there's no reason why they should do it, but it's essentially keeping costs low and doing what they do and trying to get better. So the same mindset that you want in a capital allocator, right? And that's about as much assurance I can give. I can't say that his next bet is going to be correct or not.
Right. So talking about corporate culture, Heather, you're a leader of Diamond Hill. How are you using the Moat framework to build like moats or even wide moats and competitive advantages in the firm? You have $30 billion under assets under management, right?
Yep. So we spend a lot of time thinking about what our competitive advantages are and how we can make investments in the business that will help us enhance our competitive advantages. And investment management is kind of an interesting industry when it comes to thinking about competitive advantage. And so, when I take a step back and really think about where I think we as a business have the ability to really differentiate ourselves, culture is definitely one of those areas where, we need to have a long-term mindset that really imbues everything we do. And so even though we're a publicly traded company, For example, we don't have quarterly earnings calls because we feel like while we value transparency and we know investors value it and we try to be as transparent as possible in writing, we believe quarterly earnings calls lead to management teams inherently having to fight against the urge to think quarterly in terms of how you're delivering. And we don't ever want that pressure to come into our business. So that's one example. And I mean, a lot of investment managers are not publicly traded, so they don't have that pressure at all. And our being publicly traded is kind of just a quirk of our history as opposed to an intentional decision that was made or anything like that. Another thing I would bring up too from a competitive advantage standpoint is that we have made some decisions as a business that have, I think, allowed us to partner with our clients in a way that other investment managers might like to do theoretically, but are restricted from doing because they have not been set up that way originally. And one of those examples would be that we are very focused on capacity constraints. We would rather constrain capacity to make sure that our clients have a great experience and investing outcome than to cave to the pressure that so many investment managers face, where the more assets you manage, the more revenue you generate. And so I think that constraining capacity actually has two elements of competitive advantage for us. One is that it should lead to better returns over time for our clients. So that should lead to more loyal clients who have a better experience, et cetera. But the other element of it is that it actually requires us to think very innovatively. If we would like to grow as a firm, and I do think at a minimum a growth mindset is really important to a successful firm, that we need to constantly be thinking about how else can we solve our clients' investment needs. What other capabilities might we be able to bring to the market with our unique lens and our unique competitive advantage. And so that kind of innovative mindset, I think, is unfortunately unusual in our industry. And I think a capacity constrained mentality actually really enforces that for us. Another thing I'd mention too is that we are very particular in restricting our employees from investing outside of the investing that we're doing for our clients. And the challenge in that, of course, is that we hire lots of people who want to do nothing other than investing. And so they'd like to be able to frequently invest on their own as well as invest for our clients. But that does create an inherent challenge and conflict that we believe cannot be appropriately mitigated without asking our employees when they join the firm to commit to basically investing for our clients. And we all benefit from that because we all are clients as well. We can invest in our own capabilities and we can benefit from all of our investing acumen that way. But what we do not allow is for our investment team or anyone else in our company to invest on the side in a way that conflicts with decisions that we are making for our clients. And our policies on that are a lot more strict than most firms. And I think if other firms in the industry wanted to try to copy that, they would have a very challenging uphill battle to try to convince people who currently have some freedom or autonomy to invest separately to give up those freedoms. But with Diamond Hill, we just ask that commitment from the day somebody joins the firm. So it's not ever had to be something that we've asked someone to change. It's been kind of a foundation of how we built the culture with a client first mentality. So I think there are more, but the interesting thing is what I'm telling you, you cannot easily put into any of the Moat sources in Morningstar's book, right? And so it kind of goes to Krishna's point from before that I think when you really get into the intricacies of understanding businesses, I could pigeonhole us into a Moat source or two if I really had to, but ultimately it's so much deeper and more nuanced than that. So
maybe there needs to be more categories in those 5 sources.
Maybe. We can recommend that to Morningstar.
It's like that mental model. The map is not the territory. So in reality, it's difficult, but we use models in order to make it a bit easier. I was also thinking, Heather, how do you manage your days in order to you want to widen the moat as much as possible. And that's I guess, your main focus. But how do you manage your days in line with that?
Well, I would say I try to spend, I don't really manage my days in this way, but I would say on a weekly basis, I try to make sure I'm spending a reasonable proportion of my time thinking about and working with our clients and really understanding the client experience. We spend a lot of time really making sure that the partnerships that we have with our clients are as long term as possible, as we talked a little bit about before. And that requires a real commitment. So, for example, during this pandemic, the timing of when I, as a new CEO, might have gone out to meet with our clients in person, I could not do that. And so instead, I had phone calls, Zoom calls with many of our clients. And it is so interesting to me how many of them expressed that they had never heard from the CEO of an asset manager that they'd partnered with before. And so that's just an example, I think, of where this client first mentality really ends up embedding itself in our culture and the way we behave on a daily basis, and even the way I, as the CEO, behave. And then the second thing I would say I am very focused on is our employees and our colleagues. So I'm actually about 2/3 of the way through meeting with every single employee on a one-on-one basis, some over Zoom, some in person, depending on people's comfort level and things like that. But I really try to stay connected to every employee because I think that we are in a big people business, and our assets do walk out the door every day. And so making sure that everyone feels that they're part of a positive, supportive culture that is, has a purpose that they want to be part of, I think is just a really, really important part of what I do as the CEO. And then the third category, I would say, of how I spend my time, I kind of put into strategy. And kind of thinking about, well, where is this firm going over the next 5 to 10 years? What else can we do when we're partnering with our clients? How else can we make sure that we are a great place that talent would love to come and work? And so it's kind of in that category that I would say our shareholders ultimately end up benefiting. But because we take such a long-term perspective, we really try to cultivate a long-term shareholder base as well. And so I talk to our shareholders infrequently. I would say highly infrequently. We do have an annual shareholder meeting that we publish on our website, and I'd say we publish it now because it's been on Zoom for the last 2 years. But hopefully, eventually, we'll be able to go back to holding that in person. But I really think once a year is enough in terms of communicating with a truly long-term shareholder base.
Sounds like Berkshire Hathaway.
Yes, that is not entirely an accident. Morningstar, also a public company, they also don't do quarterly earnings calls. So I would say there's, and Morningstar has definitely been kind of built on a foundation of love and respect for Buffett. So there's some common themes running through that and my background and who I've learned from in my past as well.
Yeah. Krishna, do you have like a specific way your days are structured, or is it a bit everything? What happens if Assa Abloy buys a company, you do that, or do you have some kind of habits?
Yeah, and I want to say that's the biggest luxury in this job is most of the week is unscheduled when I'm not traveling, and I like to travel a lot on work and meet companies, but that's it's become Zoom meetings now, so. Waiting for the day when I can do that.
So do you feel like it's a big change not meeting the companies physically?
I think we're getting a lot of access to management teams. What I miss is meeting fellow investors, right? So to get the kind of like the grapevine talk on what people are thinking and just build those relationships, because they are very helpful if you find like-minded investors in just kind of learning things that you might have missed. And it's to my earlier point on information filter, I want information to come from certain people, and they're worth a lot more than from other people. That sort of thing. But yeah, in terms of access, we get a lot of access, so that's we're thankful for that.
But otherwise, the schedule is not very busy.
Yeah, it's it's during earnings season. There are a few more. I like to listen to every earnings call or at least a transcript. So and that of the competitors as well of the companies that we invest in. So that tends to be busier, but by design we want to keep it open so that you just have more time and you're more relaxed to do new work. and especially the period between earning season is really the fun period when you can start looking at new things outside the portfolio. So yeah, it's pretty open.
Right. And this being a book podcast, we're also curious to hear like how much time do you spend reading in a typical day?
Me personally, I think that's the only thing I do. I think my kids think I get paid to read. So,
And what do you read more than 10Ks?
so I mean, I try to. I mean, I read books all the time, and it's it's annual reports, sell side research. It's usually I'm trying to figure out something about. Usually have one project going. So right now I have a project on Poland, which is a country I'm trying to understand. So I'm reading a book called A Country in the Moon by Michael Moran, which is it's about I think 10, 15 years old. It's a travel book about Poland. Poland is a fascinating country. And I knew nothing about the history. So, uh, I mean, in general, I would say travel books are underrated. There are so few of them, and the good ones they kind of bring out both the history and the geography of a place using real characters, right? Like, so those kind of books are really, I mean, I could probably get all that information from Wikipedia and from Google and from other drier books, but this is a much more fun way of understanding Poland. Um, I would say it's it's interesting as a country because over the last 20, 30 years since communism, it seems to be coming out of the communist shell while still retaining some of the inefficiencies and the bureaucracies of communism. We're a very young and highly educated population, especially in tech. So that combination just looks interesting. We don't have ideas per se, but it just seems like um, there is potential for moats there, right? And this is another interesting point on moats. I find that moats in smaller, I mean, I mentioned moats are created locally. Moats in smaller geographies tend to be stickier for longer. There is just not that uh, level of competition. And once a moat is established and you kind of understand what it is, there could be a long runway for that moat. But of course, you have to go carefully because the markets are new to you and you have to really understand where it's coming from. So,
And the question is also how much can they grow if they have very good presence in one country, but that country is not huge, and then they want to expand. And
yeah, and Poland, for example, right? It's one other interesting thing about Poland is it's for a country in Europe. It's predominantly a rural country, so that can create some moats too. So depending on the sector, does that give you a longer runway in certain businesses, etc. So you start thinking along that line.
and what about you, Heather? How much are you reading in a typical day?
I would say a typical day, I am not reading much more than articles or things that, have kind of come up on a more timely basis. But again, in a typical week, I read probably a book a week. I love reading. I feel like some of my greatest, deepest insights come from reading. And, I've sort of moved my reading repertoire to be more focused on books that are kind of about building great cultures and leadership and things like that I think make sense given my current role. And we also have started having kind of a book club within Diamond Hill where we'll all read a book together and then have a discussion on it that we invite the whole company to participate in if they're interested in. I think it was probably maybe even a year ago now, we read a book called Unleashed that was excellent, really great book. It has a long subtitle that I could send you because I know there's some other books called Unleashed, so it can get confused with some other books. But
We'll put that in the show notes.
it was just an amazing kind of examination of different elements of building an inclusive culture that I just thought was a super powerful book. And then recently as a firm, we also read Annie Duke's book, How to Decide. So I'm sure you've come across that. I think it has great applicability for investing decisions and business decisions and so much of life. So it's funny, like we kind of had a funny discussion about how it doesn't feel like the best written book because it sort of makes you work, and it is, organized kind of, there's a lot of quizzes and things in it. But I think everyone who read it and participated in the discussion found some really useful insights in it, which is really the point, right? It's ultimately, if you get 2 great insights from a book, then it's a huge success in my mind. So I'm currently reading a book called Grow the Pie that was recommended to me by one of our portfolio managers, and was really about more of a purpose-driven mindset and multi-stakeholder mindset in managing companies, and how companies think about their purpose. So
nice. Krishna, do you have any investment-related book that has really influenced you in your career?
Oh, I mean, that's I don't know where to start. I mean, there's tons and tons of books. I think the number one, I think I mentioned this earlier. I started with this book called "You Can Be a Stock Market Genius" by Greenblatt. It's sort of a ridiculously titled book, but it has probably influenced my thinking for a long time. But I mean, since then, I think I've pretty much read the entire gamut of books, and starting from Intelligent Investor, it's security analysis. But what I got from some of those older books was not really. I mean, usually the lessons I got were probably different from security analysis, for example. I didn't care for any of those analysis on railroads and all of that. It's more like the history of the time and what he was going through, and his Ben Graham's understanding that at the end of the day, what really matters is being able to invest through the cycle rather than great ideas, right? Like he went through the crisis in 29, and the people who did well were the people who had excess cash to invest. Those kind of learnings kind of stick with you rather than the details of some of these books.
I think it was interesting, Heather, when you mentioned Danny Duke's book, and that it leads to action, and that I agree. I mean, really, when you read a book, it's an active journey. It's not passive. Many people read books passively, but then I think you miss the learning piece actually. So it's about, do you read for fun or do you read for learning?
I have 2 teenage sons, and so I've decided that this year, because both of them tend toward math and science as their area of strength, that I'm going to read for my fiction contribution to my life. I'm going to read the books that they have to read for school, because I don't know how else to help them when you get to the teenage years. I just don't think I'll be able to help them with their homework effectively if I haven't read the books. So my reading list will be changing dramatically.
That's good motivation. I feel like we could talk about books and investing and moats forever, but we need to cut here. We are very thankful that you came on the show, Heather Brilliant and Krishna Mohanraj from Diamond Hill. Thank you so much.
Thank you so much for having us.
Thank you so much, guys. It was fun. Enjoyed it.
Thank you for listening to Investing by the Books, a podcast by Redeye. You can follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve the podcast, we really appreciate your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. For the editing of this podcast, we thank Jon Hintze, and for the graphic design, Jesper Viking. I'm your host, Eddie Palmgren, and until next time, I sincerely wish you the best of luck on your journey through life and investing.